That's an apropos question as the calendar is about to turn from January into February. Last year, if you recall, January was a month sort of like this one, where it was a very bullish market. Actually, I guess there was more news that pushed the market higher. I would say this January, the rally has been more characterized as a bounce off of oversold levels after a very rocky December. Last January, there was the enthusiasm over the signing of the new tax law. So the characteristics of the rally are very different. So last February, I think you saw what would almost be the climax of a few different trends. You saw this bullish January, which had been through more or less a bullish 2017, and market was rip roaring. Everyone was bullish, and in hindsight, we were quite overbought. And the trade du jour was sell volatility because the market just grinds higher every day. The volatility can go lower for longer. I had a conversation with a strategist at another firm when he put out some number basically where he could see the vols going into the mid-single digits, and I said, I think you're nuts. And he said, well, the mathematics are there. That's the trend. And I said, at some point you're pushing on a string. Vol can't go much lower. But I don't think anybody really foresaw the kickback that happened as the month rolled on. The short volatility trade exploded in ways that people weren't expecting, with equity traded notes linked to the volatility indices blowing up, and people finding themselves massively short volatility with a big short squeeze. It's very hard to predict something like that for this coming month. I think what we're in now is much more of a trading market. It's a very fascinating time because of the government shutdown. We sort of have a paucity of economic reports. There's just not the economic data that's out there. I think that plays into the Federal Reserve and their decision making. It's hard to be data dependent when there isn't much data. I think I've discussed that previously. So going into February, I see a bit more trepidation in the market. And in many ways, that's less dangerous than it was last year, where everyone was happy and bullish, and the tax reform was going to pay off in spades. And now you're seeing, quite a bit more two-sided market. I think a lot of the rally we've seen in January, however, this to me is a bit of a worrisome event. I think a lot of the character of the rally we've seen in January is what's called FOMO, fear of missing out. And if you think about it logically, a lot of the sell-off last year was fear going into year-end. Nobody wanted to be long certain items, and as the market started to fall, it fed upon itself, and people were trying to protect what was left of the gains. Remember, institutional investors need to be paid, and they're not paid to be holding cash, unless, of course, cash is the right thing to be holding, which is kind of what happened in December. January, the calendar rolls along, the market starts behaving better, and almost as big of a fear to many institutional investors, besides losing money, is missing a rally, because you don't want to be the guy, as the markets are ripping higher, who's sitting in cash underperforming a rally. So I think that's a lot of the character of what we saw as the calendar flipped from 2018 to 2019. And so the question becomes, how much does that hold? I think we've started to see the markets backing and filling a little bit. There's certainly the headwinds of the Fed balance sheet reduction, which people are a lot more cognizant of, and I've started to see calls how balance sheet reductions in late January into early February and in mid-February could provide headwinds to the market. That should be nothing new. We've been talking about headwinds to the market from balance sheet reduction for quite some time. As I speak about in other places, the balance sheet is much more of a problem when the market's feeling bearish than when the market's feeling bullish. It's got a nice capacity to ignore that. So going into February, I think we have much more of a trading type of market. There's not a clear consensus right now of what's going to happen in terms of rolling off the balance sheet, in terms of earnings, which as we're sitting here in the midst of earnings season, they've been pretty good. In general, what's nice to see is the market rewarding winners as well as punishing losers. That's a nice change, as opposed to market more or less taking the winners in stride and punishing them. So I think February is going to be a very is going to be a month where you need to be nimble. As of now, it's shaping up with not a ton of clarity. We'll see where that takes us. And as a result, as always, be mindful of your hedges. Take care.